PepsiCo stock offers passive income investors a dividend yield of 3.62%. But is the stock a buy at current prices? Is it a safe dividend stock to buy for long-term investors? I'll answer that question in this video by evaluating Pepsi's previous several year revenue growth rate, its operating profit margins, its returns on invested capital, and of course the dividend yield. Then I'll look at valuations, looking at the forward price to earnings ratio and the price to free cash flow to determine if the stock is priced well enough to make sense for long-term investors. So let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So looking at a 10-year history of Pepsi's revenue growth, I see an interesting trend line. Most notably, you see that big increase in revenue growth during the pandemic. That was a result of people spending more time at home, eating more at home, snacking more at home while they were working from home. That benefited Pepsi's businesses significantly. In addition to its beverage segment, PepsiCo has a robust snack segment that includes chips. And when people were spending more time at home, people were buying more snacks at home, and that benefited Pepsi. Its revenue growth surged close to 20%. I don't think you're ever going to see Pepsi's revenue surge like that in any moment again in the future, unless it's an unprecedented circumstance like the pandemic. Pepsi stock investors will be fortunate if the company grows its revenue in the low to mid single digits. Something between 2 to 4% revenue growth would be solid for Pepsi, as the company mostly generates price increases, revenue increases with price increases, not so much so with consumption increases. If anything, consumption of Pepsi's products might decrease as people choose more health conscious options, and Pepsi's doing good to introduce more health conscious options. But they've also done a great job of changing package sizes so that they can disguise price increases, right? If they're selling you the same product and they increase the price on the product, it's obvious to see that they increase the price. But if they change the package size, then they can increase the price you're paying without quickly identifying that they increased the price, because the package size is different. And so you have to remember, what was I paying before on a price per ounce basis for this soda or this beverage? What was I paying before on a price per ounce basis on these chips? And so you forget those things. Those are not things that you readily remember or keep track of. So Pepsi can institute a price increase in clever ways to get people to pay more for its products. And that's how it's going to generate revenue growth, is by generating price increase in that way. As I mentioned, Pepsi offers a healthy dividend yield. Unlike its products, its dividend yield at 3.62% is relatively strong comparing with other dividend stocks. It's not the highest dividend yield in dividend stocks available, but it's attractive. It's in the middle tier of dividend yields according to the stocks that I evaluate and the stocks that are under my coverage. Pepsi's operating margin has recovered. It's up to 14.07%. You can see this big downtrend in PepsiCo's operating profit margin from 2018 to 2023. But even so, it's because PepsiCo's operating margin is in such a narrow range. This decline is not that big in terms of absolute numbers. It fell from 16% to 13.5%, which is just 2.5% overall. But because Pepsi's operating margin is usually narrow, that margin compression looked worse in that regard. Pepsi's returns on investor capital have been solid at 15%. This works well because Pepsi's cost of capital is so much lower than the average business. A return on investor capital of 15% is adding solid shareholder returns. If a company's returns on investor capital exceed its weighted average cost of capital, then the company is adding shareholder value. I estimate that PepsiCo's cost of capital is below double digits, somewhere between the 8% range would be reasonable to assume for Pepsi's weighted average cost of capital. So if it's generating an ROIC of 15%, it's significantly above the weighted average cost of capital, and that's what you like to see from a business like PepsiCo. Finally, let's look at valuations. When measuring by the price to free cash flow of 29, Pepsi stock looks a little bit overvalued according to this metric, but when measuring on a price to earnings forward of 17, Pepsi stock looks undervalued slightly in this metric. So combining the two, PepsiCo stock looking at valuations looks fairly valued. It's not too expensive at these valuations. It's also not cheap at these valuations. It's fairly priced. And I usually say that when I'm looking at a fairly priced business, if it's a really good business, relatively low risk, good factors incorporated into my 6-step evaluation of publicly traded companies, if it scores well across the board, which Pepsi scores well across the board in my 6-step framework for evaluating publicly traded companies, I'm willing to pay a fair price for businesses that are in that category, and PepsiCo fits into that category. So if you're a passive income investor looking to generate dividend yields, PepsiCo stock is a good option. Even if you're not a passive income investor, even if you're usually a growth stock investor, but this recent market volatility has attracted you to some dividend stocks for some diversification, for some safety in your portfolio, PepsiCo stock is also a good option for you. And so, whether you're a growth stock investor or dividend stock investor, PepsiCo stock at current prices makes for a good addition to your portfolios. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.